Good morning, welcome to our final earnings season special of the week, and we're going to have a quick recap of where the S&P 500 is so far into earnings season. But last night we had Pinterest crossing with its Q3 numbers. Shares taking an absolute battering in after hours trading, down 20%. So look for that one. If you do have a position in Pinterest, it will gap significantly lower on the cash equity open today. Earnings per share of 1 cent, excluding some items, versus 4 cents loss that had been forecast. That was a beat. Revenue of 279.7 million versus 280.6 million. Forecast like miss. Monthly active users coming in at 322 million versus 312 million forecast, and average revenues 90 cents versus 91 cents per user. But it's missed estimates on its full year outlook. I think that's really where the market, the reason for the market to sell off. I think also you've seen Google and Alphabet and Facebook performing a lot better. There are signs though that Pinterest, much smaller than those companies of course, is gaining some market share. So that is a positive. Shares are still up above their IPO level, but down from the August peak. So mixed bag, I think, from Pinterest. I think maybe that sell-off looks a little bit excessive, though. I think we might see it potentially try and close that gap a touch, but certainly not the best forecast at the moment. So far, 341 companies we've got, or around about 350 companies from the S&P 500 reported. Earnings down spot 6% on revenues up at about 5% higher, so decent revenue growth. I think that's underpinning the sense that things are not too bad for corporate America, and hence why the S&P is near its record highs. 74% beating EPS estimates and 60% beating revenue estimates. Tech sector Q3 results from 83% so far in terms of the market cap. Total earnings down 6.4%. So I think that's really, you've seen this rotation from out of growth into value, and I think partly that's because earnings at tech companies are declining a bit more rapidly than the rest of the market. Revenue's up 3.3%, but earnings per share down 6.4%, which is significantly worse than the earnings per share drop for the wider market. 83% beating EPS estimates. Financials, EPS up 1.3% with revenue growth up 12%. Q3 as a whole, I think so far not been as bad probably as feared, but certainly still showing earnings per share falling. And I think on the whole that's the case. That's why we're at the market in the broader market. The S&P 500 not far off its all-time highs. Earnings not too bad versus expectations, certainly better than expectations, and of course the Fed juicing markets with its rate cut, and of course with this stealth QE in terms of the repo market operations, which it's injected. Well, it's grown its balance sheet by $200 billion in the space of just a few weeks, something that would take the ECB a whole year to do by some estimates. So the Fed is rapidly expanding its balance sheet, and hence why I think we are seeing this more pro-risk environment. So earnings not too bad so far. Next week we've got Uber and Disney reporting for the S&P 500, and we'll look a bit more closely at those in our week ahead. I'll be back in a bit to do the non-farm payrolls live. That's at 12:30. Thanks for watching.